Okay. Okay, great. So as I was saying, guys, we're gonna start with the basics and the basics of what Forex is. And so in a nutshell, Forex is a decentralized global currency exchange, and it's one of the largest markets in the world. So it is not centered to one country, and that's why all the countries in every continent is able to reap the benefits, to participate in Forex. And that's one of the biggest benefits that we have in Forex. And basically, the basics of Forex involves exchanging of some type of currency with another at different rates. So when you buy a currency in Forex, you at the same time will be selling against another currency. So just as a basic example, I don't know if some of you guys are familiar with exchange rates. So if you want to change a currency, or if you go to another country, you have to change your currency to that currency so that you can be able to use it for flexibility reasons. However, there is an asking price that is always that they will always give you to exchange the rate. And that's how Forex works. So when I buy a certain currency, there will be a set price, an asking rate that they will give me to buy that certain currency. And in that case, you are basically just exchanging one currency with another. And if you buy one currency, you are basically selling against another. And what you can leverage that exchange rate going up and down as it fluctuates based on the economy. But that is something that we're going to discuss a little bit better later on our class today. So if you guys have any questions while I'm going through the lecture, please write them down. We'll take all the questions right at the end. And in terms of what can be traded in the Forex market, so the Forex market itself is extremely liquid and it is very active, and over $3 trillion are being traded daily in the Forex market. And so there is enough money for everyone. and it's great that all the countries and everyone in all the continents can be able to participate in Forex. And what you can trade, and this is some, not all, the instruments that you can trade in Forex include currency pairs, which is one of the most famous forms of Forex trading. So this is, again, in the illustration that I gave previously, that you are basically trading a certain currency versus another currency. So an example of this would be the Euro USD and the GBP USD, which is the Great British pound versus the US dollar. So if you are buying one, you are buying it against the other. So this is one of the kind of instruments that you can trade, which is called currency trading. Then there's commodities and metals. So you can also trade gold, things like silver, sugar, oil, salt, and rice. And again, this is you basically leverage the prices of this thing going up and down, and these rates going up and down. And you can also trade stock indices. Now, stock indices are profiles which are made up of a group of companies. So it might be, for example, the US 30. It's made up of the top 30 US companies. So now that stock being made of those 30 companies, you can then trade its progression, how the stock itself goes up and it goes down. Then you can actually have that as a tradable instrument in the charts. You have the US 30, or famously known as the NASDAQ, which you can also trade, and the S&P 500. So those are just examples of the instruments, or rather the common instruments that you can trade in Forex. Other than this, you also have your Bitcoins, your Ethereums, and the likes. But these are the common ones that you can actually trade. Then moving on to who can participate in Forex trading. So we have two main types of Forex participants. And firstly is institutions. So institutions are very, very broad. You have commercial banks, you have investment banks, central banks. You also have investment managers and hedge funds, as well as multinational corporations, which trade daily in this, which are basically trading within that $3 trillion that we are talking about. And then we have another section of traders which are called retail traders. And that's where me and you come in. We are individual investors, and not just the term trader, but investors who come into the market, and we leverage trading strategies. We leverage trading methodologies to be able to take our share in that $3 trillion, which is moving up and down, exchanging hands on a daily basis in the Forex industry. So as a person, you are then referred to as a retail trader, or rather an individual investor who participates in Forex trading. Then moving on to the more practical part of Forex. In Forex, there is what we call a pip, and this is how you measure the movement of a price or an asset, or whatever instrument you're looking at. For example, here you have your Euro USD, and right at the bottom, so up here you have your Euro USD, here at the bottom you have your USD JPY. Now a pip movement is basically the smallest unit of movement that we can measure on a price movement. So when you get the euro being compared against the USD, the US dollar, and there is a single fluctuation between the two, we call that movement, whether it's up or down, a pip movement. And it differs between where the USD is involved, and where the Japanese yen is involved. So with the Japanese pairs, you normally have 2 points at the end of the pip, and with the other common pairs, you will have 4 points after the dot. So if you go to your MT4, it will actually be 5, and for the Japanese yen pairs, you will have 3 pips or points after the dot. So you see where at the bottom you see 109.11. If you go to MT4, that would be 1.110 or 0.11 and whatever number. But the principal thing for you to know when there has been a pip movement, to be able to measure that pip movement, and that's how you calculate your profit and your losses and whatnot, is for Japanese yen, you always use the 2 decimals, the 2 decimals after the dot. And for the other pairs, you will then use, which don't have the Japanese yen, you will then use the 4, so the last 2 digits after 4 points. So you're going to count after the amount point, then you count 4, then you take the 4th one that you find in that sequence. Then basically, as explained, the pip is basically a unit of measurement to express the change in value between 2 currencies, and then the pip is the 2nd or the 4th decimal digit of a price quote. So now in this case, right, it is the 2nd decimal digit for Japanese pairs, and the 4th decimal digit for any other currency pair in the currency trading. And that's how you then measure the movement of price. And moving on from there, let me just see if I can erase this annotation. Then earlier on, I mentioned that we as retail traders, we leverage analysis types or strategies and some other instruments that are available in the forex industry to then take our share and participate in the forex industry and make profits off of it. So primarily we have two types of analysis in the forex world, and you will get further understanding in the next classes that will come. Then the first one is technical analysis, which is one of the most famous ones. And technical analysis, what it does is traders then use price movement to so we use historical price movements to determine the current trading conditions as well as potential price movements. So whenever we analyze, we look at the history of a specific asset, the patterns, the behavior, and there are tools in the trading space as well that can help you leverage this, that can help you see patterns, pick up patterns, how price or a certain asset behaves in the past and repeatedly behaves in a certain way. And so we use historical data to predict or to predict a higher probability of price movement to try and depict where price will be going in future. And that's basically technical analysis. And then fundamental analysis is a little bit different. It's less involved with looking at the charts the entire time and using mathematical formulas and all of that. With fundamental analysis, it basically is a study of what's going on around the world. So it's basically what's the economics of a certain asset. So back to the example of the Euro USD, right? So if you as a trader trade the euro versus the US dollar, you would want to be interested in, as a fundamental trader, you would want to be interested in what is happening with Britain, with London, with that side of the world, as well as what's happening with the American side of it as well. So the economics that happen, the microeconomic elements that happen, which is such as growth of the economy, inflation, and unemployment rates, and all of that then affects price movement, and that's what you want to study as a fundamental trader. However, as smart traders, we actually leverage both. So primarily, we use technical analysis to predict, to figure out, to come up with higher probabilities in terms of our trading. Then we also are aware of fundamental patterns, fundamental movements, and price action in terms of economy and the financial sector, as well as what's going on with price growth, economics, inflation, and unemployment rates, and the likes. So again, we will then learn this in more depth in future, in the next classes to come. Okay, then in one of the most fundamental parts of trading would be a candlestick, and this is how price action is represented on the chart. So as a trader, you engage with the chart, and what you will see is this candles, it's either going to be red and blue, or blue and white, or black and white. One being bearish, meaning it's going down, and the other being bullish, meaning it's going up. So we have two types of candles. Trading is basically binary in that you either have a bullish candle, meaning that price is going up. And what that basically means is there are more buyers than sellers. So your buyers are stronger than sellers. And in that case, a price movement in asset basically moves up a pip or a few pips, depending on how much buyers you have. So a candle looks like this. A typical standard bullish candle looks like this. It will have the high, it will have the close, so it will normally open at the bottom. So you have the low of the candle, which is this area here. This is the lowest point that the candle has reached. You have the open, and this is where the candle would have started, where price would have started when this candle actually started printing. Then you have the lowest area, which is the lowest area that price moved downwards. And then the high would be this area here, which means the highest area that price went up on this candle before the candle closed. And then this would be the close of the candle. So now this part of the candle, I hope you guys see where I'm pointing, is then called the body of the candle. And these parts here, the tails of the candle, those are called the wicks. And those indicate the high and the low of the candle. So how high price was able to push, as well as how low price went before it went up. And it's the exact opposite for the bearish candle. The bearish candle basically is a candle going downwards. So your sellers are stronger than your buyers in this case. Whenever you see a bearish candle forming, then in this case, you would have the open, meaning that this is where price opened for this bearish candle. Then the high, meaning that this is the highest point that the buyers or the bulls pushed the candle up before it went down. And then this here being the lowest, or the low, which is the lowest point where price pushed down before it closed. And in this case here, if it went this far, then it means that the sellers were pushing way down, then the buyers resisted a bit, and the candle then closes here, where is the close of the candle. So basically, a bullish candle means that the buyers were stronger than the sellers, and a bearish candle means that for that time period, you have sellers being stronger than the buyers. Okay, then getting to trading. When you do trade, you are going to need a platform to trade on. So primarily you would, one of the most famous trading platforms is MetaTrader. You have Mt4 and Mt5. It is totally your preference which one you want to go with. And so MetaTrader is a platform that is used both by traders and brokers. Brokers use it to reach a broader audience. So brokers primarily have their own platforms where you can open an account with a broker and trade on their platform. But because MetaTrader is so famous, they also, whenever they also want to submit their names so that you can be able to use it as a platform and still use them as brokers. And we'll talk about brokers just a little bit later on. And then as a trader, how you use MetaTrader is it's a channel for you to be able to place orders on real time. So you can be able to see price movements in real time, and you can be able to pick what is the price of gold at this time, what is the price of oil at this time, meaning exactly at the time when it moves. And you're able to see the open, the close, and all of those things, and you can be able to analyze both the technical as well as the fundamental part of movements, as well as patterns that you see an asset printing on the market. Then there is something that is called Trading View, and Trading View is a very powerful platform. that traders, every trader that I know uses to leverage the charts. So it has a lot of tools. It has a lot of features that can assist you in, especially in technical analysis, to be able to do your analysis. Once we get there, you guys will understand it a little bit better. But it is, in my opinion, the best platform that you can use for analysis. So even though you place your trade on MetaTrader, this as Trading View helps you to do your analysis, to plan your analysis before you execute it on MetaTrader. You can, of course, connect brokers with Trading View, but they're very, very limited. So it would be it's a limited range of brokers that you can actually connect to TradingView. Okay, then brokers. This is one of the most important parts before you trade, is knowing what broker to enroll with. So a Forex broker is basically a financial intermediary between you and the market. So whenever you press buy, they are the guys who execute it, who sends that request and make sure that it happens at the time. Whenever you sell, same thing, right? So these guys basically are a intermediary between you and the market, and they're not supposed to benefit out of that transaction. They work at a commission, which is called a spread, which would be explained in future as well. So these guys help you with trading. You cannot trade without a broker. You cannot place a trade without a broker. They are the guys who basically deliver the message. If you say, I want to buy gold at this point, they send that request, and they get it processed. And you have two types of brokers, and this is why you need to know this. You have regulated brokers and you have unregulated brokers. And regulated brokers are simply brokers which are licensed and they are authorized to operate as a Forex broker in your country. And unregulated brokers, it's the opposite. So these guys are not licensed, they're not authorized to operate as a broker in your country. So, and the reason there's a regulation, this regulation basically is rules and laws that firms operating in the Forex industry must follow. So the financial institution board that governs all financial all financial transactions, all financial companies, whether it's banks, insurance companies, and the likes. These guys are the same guys who govern brokers, who make sure that they regulate brokers. And the purpose of regulation is to protect you as a trader from undisclosed financial risk, and as well as abusive practices like price manipulations and order manipulations and fraud and all of those things. I'm sure if you have been involved in trading, you would have had someone losing money and blaming it on the broker and saying that, hey, they manipulated price. So this is the reason why brokers need to be regulated. So before you open an account with a broker, you need to check and confirm that they are regulated and authorized to operate as a Forex broker in your country. That way you know that you are safe and that there will not be any manipulations or you will not be losing any money from trading manipulations and the likes. And guys, that is basically all that we have for today. It's an intro. I hope it was not too much, and we'll be able to take questions now. Thank you so much for your time, guys. Over to you, host. O- Okay, guys, if we have any questions, we'll be taking questions now. Okay, I see there. Does this cover synthetics? Okay, we've got Mr. Matthew. Yes, you can unmute yourself, Mr. Matthew, and ask your question.
I can't unmute. Wow, I'm muted myself. Okay, so you can actually unmute yourself.
Yes, you can ask your question, sir. Okay, I see, Mr. Okay, there's just so many comments coming through here. I don't know if. Okay, okay. Mr. Godwin says thank you a lot, sir. Mr. Theophilus, thank you. Well done. Does this cover binary trade? Okay, yes. So with VTN and when we are trading smart money with any institution which you guys would be in, right? Analysis, when we do analysis, it is the same. It works the same with binary as well as currencies and stocks and the likes, right? Only that with currencies, sometimes there's a little bit more that you can do to analyze. It's the real market, so there's a little bit more that you can go into and more that you can learn and use to analyze as opposed to synthetics. But yes, it does apply to synthetics, and with synthetics as well you get regulated brokers as well. I know Deriv is a regulated broker here in South Africa as well. So yes, it applies to synthetics. I hope I've answered your question, Ma. Oh, yes. Okay. How do I know the broker is regulated? You can go to their website. Just check their website. It should say if they are regulated. If you want to know and you're going to a specific field, you can maybe just talk to the other traders that you know. Please ask around, and you can just check on Google as well. Just Google if they are regulated. It will tell you if they are regulated or not regulated, or search for regulated currencies brokers, and it will let you know as well. Thank you so much for the knowledge. Okay, it is a pleasure. I've got God's power. Thank you so much for your time, sir. Okay, so how do I calculate pips? This is Onkere. Okay, so it depends on what you are calculating. If it's synthetics, so and again, the reason why you want to calculate pips. So for example, you can calculate pips to figure out what your stop loss is. So if you want to know how many points your stop loss would be, all you need to do for synthetics, as an example, just take your starting point, subtract your end point. That will give you your pips. However, with currencies, wherever you have the Japanese yen, just take again the start point minus the end point. However, just delete the last digit. And it's the same with the other pairs which don't have the Japanese yen. You need to delete the last digit, which would be 5. So you would have 5 digits after the point. Then delete the last digit, you will have the number of pips that you are calculating. And go ahead with the questions. Okay. Why should I calculate significance in trading? The reason you calculate pips is you can calculate pips to know what your stop loss is. So and then you can in turn know how much you are losing if your trade hits stop loss. You can calculate pips as well to know what your take profit is, to then know how much you will be making in a trade if your take profit is hit as well. And that's the reason you calculate, some of the reasons that you actually calculate stop loss and the take profit. Okay, let's see. I've got Mr. Adai. You can unmute yourself, Mr. Adai.
Okay, good evening.
Evening. How are you, sir?
Yeah, please, I want to know what leverage is.
Leverage. So leverage is basically so let's say you have $100, right, that you are using that you deposited in your account, and you want to trade using $10. Not a great example, but let's say you want to trade using $10. There is a certain amount of money that you can use to buy, let's say 1 pip, or rather, let's say 1 lot rather. So because that amount is a high amount, so in this example, let's say you have $100, you're going to use $10. However, a lot size, a certain lot size, if you want to buy 1 lot of, let's say 0.1 lot of Euro USD, and it costs $1,000 to actually, the price equivalent is about $1,000. So your broker then gives you that leverage. So it's kind of like you are, they give you the ability to control a large amount of money using a small amount of money. So when you trade, they then give you that with your $10, you can actually buy an equivalent of $1,000. So it allows you to be able to purchase a higher lot than your actual balance can. So that's why you see, if you open an account, it will tell you, it will ask you or give you a leverage of 1:200. So as opposed to using your 1, you will be able to use up to 200 times what your money is actually worth. when you place a trade. Not sure if I've answered your question there.
Yes, you've answered it.
Or
Thank you.
1:500. Okay, thank you so much, sir. Okay, any other questions? Let me check the boss. Thank you for the information. Trading is fundamental, taken into. Okay, so Godwin, Mr. Godwin, I am not aware of any fundamentals currently with synthetics, right? Synthetics trading. However, and the reason is because synthetics is again synthetics. It's a simulated market. So what happens in synthetics is it is mostly algorithms trying to mimic what happens with your real life market, your currencies, your stocks, your commodities and the likes. So they aren't that many big players. So the reason you have synthetics, or rather the reason you have fundamentals, is because of big participants within the market. So your banks, your hedge funds, your hedge funds managers, your central banks, which are like the bigger participants, and that's why they affect that. But with your synthetics, it's mostly moved by algorithms more than anything else. That's why there isn't any fundamental impact on it. There isn't that much fundamental impact on it. So no, you don't do any fundamental analysis on synthetics. I hope I've answered that question. Spread. So for now, in terms of the spread, what you would need to understand is that whenever you buy or you sell a currency against another currency, because you need a broker to place that trade, to place that trade or to make that purchase, there is a commission that the broker will charge you as much as when you transfer money to your friend. There is a transfer fee, transfer charges. It's more or less similar, right? And how you will see a spread on the how you will see a spread when you're trading is that, let's say, whatever a price is, let's say Euro USD right now is at 0.01. Your broker would be able to add their spread on that, so that when you make the purchase, they've already added their commission in that. So instead of buying the price at 0.01, you're buying it at 0.03 with the 0.02 those pips as the spread or the commission for the broker. So they just add their fees in there for them to be able to make money. And that's basically what you should just understand at this point, what the spread is. I will leave that question to the host and the organizers of the bootcamp to answer if it is okay for them to share the topics that are going to be shared in the bootcamp. Any other question? Okay, I think we can. Okay, I think that's all the questions. Yep, I think we can give it over back to the host. Thank you so much for your time, guys. I really appreciate it. If you guys have any question, you can drop it at the bootcamp. You can just let the organizers know, and the bootcamp will be running. It's on fire. We've just started. The reason for today's class is because when you start with something, we are trying to touch all medias of people, the learner, the one who just started, who doesn't know anything about Forex, as well as the person who knows about Forex and has been losing money. I hope that even that person has learned something today, and as well as that person who is at a consistent profitability stage, that hopefully they've learned something today as well. So we're just trying to get the beginner, the intermediary, and as well as hopefully the professionals are in today to learn something. But the stuff that we're gonna be learning is big stuff. It's great stuff, and great. Okay, sorry guys. Back. Yes, so we are gonna be here tomorrow as well. It's gonna be same time. Let's not be late, and thank you so much for your time again. I'm just gonna take it back to the host, and let us know if you have any other questions. Thank you. I know if you enjoyed the class, let's just drop a 111 there. More is coming, more sauce. Okay, thank you so much, guys. Mr.
Okay.
Host, over to you.
Okay, thank you. Thank you very much, Head of House. Thank you very much for that amazing, it's not amazing, let me say super amazing presentation. Like you broke it down to the lowest level for anybody that is just coming into the Forex market to understand the preliminary information needed to soar higher in this market. Thank you very, very much for making our time to teach our people. You're a very, very busy man, and then out of your busy, schedule, you see, you're still giving us a part of your time. It's not something we're taking for granted. Thank you very, very much, sir. For the participants, I sincerely want to apologize for the little issue we had today. We envisaged this, and then we planned that we were gonna upgrade the Zoom account while the call is going on, only for us to realize that we have to end the call and then initiate another link for that to be possible. And then we don't want to cut the flow, we don't want to cut the vibe, so we just decided to let it flow like that. So the video will be uploaded. The video will be uploaded on YouTube, and then the link will be sent to everybody. The link will be dropped on Telegram, the Bootcamp Telegram group. The link will be dropped there for everybody to take advantage of. As soon as we are done with every session, the link for the videos